certainly the market has been discounting that everything is going to go well in the whole vaccine situation, and it's all about the vaccine at this point. We have done analysis that says we have to have 3 to 4 million vaccinations a day in order to get 80% vaccinated by June. And even the Biden administration is saying that they're trying to get 1 million a day. And of course, we've been at about a third of a million a day. So we're concerned that people's expectations of how quickly we'll be back to whatever is called normal is going to happen.
This is very much the Taylor Swift shake it off market. It has been for years now at this point. There are a lot of worries out there. What's front and center besides the idea that COVID could have flare-ups and the vaccination process could take longer than normal? What else is out there that we should be worrying about?
Well, again, once the Georgia results were in at the earliest part of this month, then there was a view that there would be tons of stimulus out there. And as you've already reported this hour, the question is how much will there be? And certainly the 1.9 billion doesn't look like it's going to happen. And even at 900 million, how much stimulus is that really for the economy? And will it get us through until we have everyone vaccinated? We question that, and again, we think that the market is too exuberant for that.
So the market's too exuberant. It arguably has been for a while. We've got a situation these days where the markets are at record highs. People are getting paid the least amount in terms of yield to own junk debt that they have on record. What exactly then does power the next leg higher? It seems as though we're running out of positive catalysts.
Well, we think that you are running out of positive catalysts. There are some structural things that the market could start focusing on if an infrastructure deal looks like it's going to happen. That could be a catalyst for the market. Also, we would not discount the move to clean energy. Clean energy is a big part of how the Biden administration wants to approach the whole climate change situation. And if clean energy becomes a focus, everything that has to do with clean energy in a number of different sectors will probably be emphasized.
There's also been a case being made right now that the U.S. markets are elevated, perhaps arguably even overvalued. Are there other parts of the world in emerging markets or developed market economies that present at least better values compared on a relative basis to what we see in the U.S.?
Well, we've already seen emerging markets do quite well in the fourth quarter through today. And the reason why is that I think that there's a view in the marketplace that many of these markets, especially in Asia, have been ahead of the U.S. as far as containing the virus. They still look cheap, but the developed market internationally looks very cheap. When you look at a price to book basis versus the U.S., it's almost historically cheap. So we think that emphasizing high quality companies and funds in the developed market is going to be not only a winning way to invest this year, but certainly over the next 3 to 5 years, those are going to be some of the best markets out there.
Shepard Smith here. Thanks for watching CNBC on YouTube.